So global travel basically slammed the brakes in March, yet somehow Booking Holdings still pushed through over $53 billion in gross bookings for the quarter, and the market rewarded them by absolutely dumping the stock.
The market hates uncertainty right now. It is really that simple.
It really is. Welcome to Earnings Unscripted, by the way. Today we are digging into the Q1 2026 numbers for Booking Holdings, ticker BKNG. It is April 28th, 2026. And look, if you just book flights and hotels online, you probably use them. But behind the scenes, the volatility here is wild.
Well, the tape is certainly brutal. The stock spent the entire fiscal quarter bleeding out, down roughly 23%. Then they printed these results, and it took another definitive leg lower after hours, shedding about 6.5% to settle around 165.
Which, honestly, seeing that share price in the 160s still completely messes with my head after that massive 25-for-1 split they did earlier this month. It just feels wrong. Oh, and quick reminder, nothing we say here is financial advice. We are just sharing personal opinions, so do not sue us if your flight gets canceled. But Miro, looking at the actual fundamentals, the sell-off feels almost like an overreaction.
It does seem extreme if you just look backward. I mean, the core operations, they're actually highly resilient. They pushed 338 million room nights. That's, I think, up almost 19% sequentially. Revenue hit $5.53 billion, up 16% year over year. But the forward-looking fear is what's driving the bus here.
Right, because of the Middle East conflict. Glenn Fogel was talking about how flight corridors just snapped, people getting stranded in Dubai at 2 a.m. because the transit hubs literally just shut down.
Exactly. They saw an immediate spike in cancellations across the board. Room night growth practically cratered in March, down to just 1%. You take a massive geopolitical transit shock like that, it shaves an estimated 2 percentage points right off the entire quarter's growth. But honestly, the only reason they survived that March freeze is because U.S. domestic travel completely bailed them out.
Yeah, U.S. demand was surging up into the low teens for the fourth quarter in a row, which, I mean, that totally defies all the macro doom and gloom we keep hearing about the consumer pulling back.
It is, yeah, it defies gravity, really. And then you look at the bottom line. Net income is printing at $1.08 billion. That's up 225% from last year, bringing GAAP EPS to $1.36.
Wait, up 225%. That number feels like a typo. How do you stall out in March but essentially triple your net income?
Because you have a giant non-operating accounting swing. It's an optical illusion. They booked a massive $333 million non-cash foreign currency gain on some euro-denominated debt. Last year, that same line item was a huge loss. So the swing completely distorts the real profitability story.
Okay, right. The old FX debt trick. That actually makes perfect sense. And I know they're doing some really fascinating stuff with AI to offset costs, too, like their assistant Penny actually booking the trips now natively. All right, let's get into the details on all that because I want to see what this business actually looks like when you strip out the financial engineering.
If we are strictly stripping out the engineering, I actually have some bad news for you about their operating expenses. It is not just the debt side that is messy.
Wait, really? Because the top line looked like they kept costs pretty contained.
They did, on paper. General and administrative expenses plummeted 17%. But that is entirely because they booked an $89 million one-time gain from a lawsuit settlement where they were the plaintiff.
Okay, yeah, Booking suing someone else and winning. I guess that helps the bottom line.
It literally does. Plus, they got a $17 million retroactive benefit because Canada just repealed its digital service tax in March. So you strip out those little one-off bailouts, and their core fixed operating costs actually grew roughly 14% year over year.
Jeez, that is a chunky jump.
Right. Which makes you wonder, they took a $25 million hit in restructuring costs this quarter. They're targeting $500 to $550 million in run rate savings by 2026. But beneath the surface, their core headcount and engineering spend is clearly still inflating.
See, and this is why I was so interested in the whole AI narrative they kept hammering on the call. If the core engineering is getting expensive, you have to find leverage somewhere else. And it sounds like they're finally making that pivot from, AI just being a cute chatbot to actually acting as an agent.
Yes, exactly. And that is the part of the report I genuinely respect. They're not just using the buzzword to drive search traffic.
Right. They have this assistant, Penny. And Iwet was saying, I have the quote here, "We are very happy that for Penny, you now can really book through Penny directly that accommodation or flight," which is a huge structural shift. I mean, we're so used to these AI tools just giving us a nice itinerary, but then you still have to go do all the manual data entry yourself.
Exactly. It is native cart execution. But the real margin magic is what happens on the back end. Glenn Fogel was talking about his vision being to treat the customer like they used to be treated when they went to a human travel agent back in the day.
I love that framing, taking the friction out completely. If my flight is canceled in Dubai at 2 a.m, I definitely do not want to hold for an hour with customer service.
Well, and it is already working. They casually dropped this little metric about Agoda. They saw a double-digit year-over-year reduction in customer service cost per booking.
Wait, hold on. A double-digit reduction just from AI automation?
Purely from AI-assisted automation, yes. That is actual, concrete operational leverage. Most tech platforms right now are just burning cash on data centers, hoping for revenue later. Booking is using it today to structurally deflate their internal costs.
Wow. Okay, that actually completely changes the margin story for me. If they can roll that Agoda efficiency across the entire platform, that $500 million restructuring target suddenly looks extremely realistic.
It does. It is an elegant setup. They let the models handle the friction, reduce human overhead, and the margins naturally float up. Although, to be fair, they might need every penny of those savings just to pay the incoming EU fines.
Oh, right, because they got designated as a very large online platform, or VLOP, right, under the new Digital Services Act.
Yeah, VLOP, which means brutal supervisory fees, strict parity limitations, and an army of compliance auditors. Oh, plus, they still have a suspended €485 million antitrust fine in Spain that could trigger at any point. So the cash flow could take a sudden, massive hit down the road.
There's always a looming black swan with European regulators, isn't there? So with all these weird cross currents, you have the geopolitical drag, the hidden cost inflation, but then this very real AI efficiency playing out. Where does this leave them heading into the summer quarter?
Well, defensively, let's just say that. They are guiding Q2 room night growth to just, I think, 2 to 4%, because they are modeling for the Middle East conflict to basically drag across the entire quarter.
Wow. So a full 3 months of that transit freeze instead of just a few weeks in March. That is really going to stunt the early summer momentum.
It is a clear headwind. Management estimates it will cost them about 300 basis points in Q2. So gross bookings and revenue are only expected to grow roughly 4 to 6%, but they are preemptively halting discretionary spend, cutting corporate hiring. They want to lock down near-term profitability before the top-line damage actually hits.
Which is honestly pretty prudent. And listening to Glenn Fogel on the earnings call, you really get the sense he is completely unfazed by macro shocks at this point.
Oh, he has definitely seen it all before.
He actually gave this amazing recap of his career. Like, he was there for the 9/11 shutdown, the financial crisis, the Icelandic volcano that grounded Europe, the pandemic. He basically just told investors, look, we do not know when the current crisis is going to end, but we do know it will end. People will travel again.
That is the ultimate bull case for the entire sector. The industry is essentially just an endless cycle of panic and recovery. And you can see they are already looking past Q2. They slightly lowered the full-year midpoint, sure, but they explicitly reaffirmed their long-term growth ambition.
8% revenue growth, right?
Right. At least 8% gross bookings and revenue growth and 15% adjusted EPS growth for future years. They just have to weather a few messy months first.
Assuming no new volcanoes erupt and the EU regulators do not accidentally seize the balance sheet in the meantime.
Always a distinct possibility over there. But if it happens, I'm sure Penny, the AI, can just book them a great deal on defense lawyers.
Totally native checkout. All right, that wraps up our look at booking's chaotic but very fascinating first quarter. Thanks so much for hanging out with us, guys.
Take care, everyone. We will catch you on the next one.
Just a quick note before the mic's cut. If you like these earnings breakdowns and want them to just show up, hit follow on the show. We actually generate this podcast with the help of AI to turn those massive corporate filings into a chat you can naturally listen to on a commute. And we would love to hear your feedback. Drop your ticker requests at earningsunscripted@datamadness.ca or grab the X link right in the show notes.
See you out there.